Hi, and welcome to the October edition of my monthly newsletter. Every month I try and compile some different information and research I'm running across, along as trying to compile some different client conversations I'm having, really all pointing towards the same question, and really the same comment or question or conversation I've been having recently with clients is the statement around this time is different. Specifically coming from clients to me, talk about how this time is different. And I will agree that the current market decline is different than other market declines that we've seen. This is completely correct. And that our current market decline is different than what we saw with the COVID-19 recession in 2020, the financial recession of 2007 to 2009, the dot-com and 9/11 recession in 2001, the 1987 flash crash, etc. And if we are in a recession now, and by the way, the NBER has not said so, at least not yet, but let's say that we're in one now, then that means there have been 9 recessions over the past 52 years, and that each recession has been different than the others. And so, yes, this time is different. The market is declining for different reasons, and yes, I'll also disagree with anyone who believes that today's economic environment is the same as the stagflation environment of the 1970s. Because today's economic environment cannot replicate what happened in 1971 when Nixon took us off the gold standard, because that only happens once, and then inflation surged for close to a decade. Prime lending rate followed by going up by 20%. The unemployment shot up to 10%. And all this happened until 1982 when Volcker stamped out inflation for darn close to 40 years. And the S&P 500 over this period of time has enjoyed compounded returns from January 82 to September 22, including our current market sell-off, at a compounded rate of 11.6%. Now, yes, today's market downturn is different than what we've seen in the past, but I'd argue that every recession has been different than the others. But here's a different question. Do you know what's remained the same? What's remained the same is that the world has not ended. The world has become more profitable. It's become more productive. And if you've invested in equities, you've likely increased your principal as well. Now, in the past 6 weeks, though, the S&P 500 has declined over 16%. Over 16% in roughly the past 6 weeks, and since the start of the year, it's down 24%. Now, none of us can predict what the market's going to do in the future, but if you do believe the world will not end, and that the human population will weather this current economic environment, then I certainly hope you can appreciate the thought and sentiment that these companies are on sale and potentially ripe for the buying. Now, let me be clear that I do not want a recession to occur, and yes, I am fully 100% ready for the current market downturn to change. However, though, if a recession is what is needed in this country to stamp out inflation, I'd say so be it. High inflation is a disease, and it needs to be treated with swiftly and potentially with painful side effects. And for any client of mine, we fully expect the market to be volatile, to have ups and downs. So this present market decline is not unexpected and does not change the view of a long-term goal-oriented investor. Now, let me change this a little bit and talk about risk. Because, as we see the market has dropped, and really aggressively so over the past few weeks, my personal view is that holding cash has now become a risk, and that for over 100 years in the market, there has been an inverse relationship between the price of a stock and its underlying intrinsic value. Okay? So, let's say, for example, you see a stock company on the TV, and you see it has this massive soaring price. You might think, hey, let's buy this because it's going up. However, right, as the stock price is going up, my thought then would be that the underlying intrinsic value is then going down. Now, assuming you agree with this basic statement, then I'd assume that you also agree with the converse statement, which is as we watch the broad indices fall from their current prices, the thought would then be that we would see the intrinsic value going up. Now, while most of us agree with this idea, it's an entire thing different to act on it. Because buying when everyone else is selling, when everyone else is saying that we're in a recession, is painful. But let me share a couple items that could be our silver lining, and I don't know. But Bank of America publishes a fund manager survey every month, and really just to get a feel for what fund managers are doing or thinking. And the chart below is from the September survey. And as you see on the September survey, let me get myself out of the way. From the September survey, is that here is the S&P 500 being down, and here are the fund managers that are overweight on equities. And my idea on this is that it could be now is the time to buy. Now, another chart from the same survey is looking at what fund managers are thinking when it comes to a recession. So, again, get myself out of the way. Okay, you can see these three high points: March 2009, April 2020, September 2022. Now, those high marks in March 2009 and April 2020, those are the months that of the those are the months of the last two most recent recessions when they turned around. So the question then is, are we turning around now in 2022 with this high point? I don't know. I don't know if it needs to go a little bit higher. I don't know if we've hit our high point. I don't know if it's starting to level out, as you can see here. But my personal assumption is that if we aren't turning around now, I would have to believe that we are certainly close. At least that's what I'm hoping for. Now, with this stated, if you think about this and you think of if you deploy cash now and you're buying into a falling market, right? Because again, the market has dropped 16% in the past, 16% in the last 6 weeks. So let's say that you buy today and you're buying into a falling market. There is, of course, chance that you would have regret as the market might continue its downward trajectory. However, if you hold cash until you have a clear sign the market bottom has occurred, I will doubt that you'll ever invest the cash until it's far too late. And that, as I see, if you invest today, there's a risk that the market could or will fall further. However, though, I do see a greater risk in being out of the next advance. So, for example, at the bottom of the 2009 financial recession to September 30th, 2022, from that period of time, the S&P 500 is up over 500% of the bottom of the financial recession to the end of September. Now, another example is at the bottom of the 2020 COVID recession to the end of September, the S&P is up over 45%. So again, we never know when this market is going to turn and when we'll hopefully continue our forward advance. However, these are some items I think could be potentially good for us. Now, every month I get asked by some clients and prospects as far as what additional information or resources I'm looking at or encourage reading. One of which I think is interesting, something that I haven't heard of before, called the power peaking syndrome. And really the comparison is looking at Germany in 1914 and Japan in 1941 as they were having aggression towards other countries, and what could be Russia's aggression towards Ukraine and China's potential aggression towards Taiwan, is that it could be a triggering action before their decline. So this is an interesting article, certainly worth reading. Another one is my favorite chart on inflation. This is simply showing the comparison of M2, the black line, compared to inflation, the red line, and you can see the relationship here, and hopefully as M2 is continuing to drop, that we'll see a continued drop with inflation. And then a final one that I think is very interesting is the 5-year break-even rate. So you can see this is as of March 22 to the end of September, and you can see the 5-year break-even rate, how this has come down quite a bit. Keep in mind that 2 months ago, the 5-year break-even rate was 2.7. Last month it was 2.5, and now it's 2.14. Okay. Now, in closing, we of course do not know what the market's going to do, and we certainly cannot control what the market does. But what we can control is our behavior to these outside circumstances. And my encouragement for all clients and prospects as well is to continue to stick with your long-term investment strategy. As always, thank you for your trust. Thanks for tuning in. If you have any questions, do not hesitate to reach out to me.